Welcome once again to the marketplace. Interest rates have seen a surge by 2%, surpassing 22%. This, as you would know, is due to the rise in inflation and consequently the policy rate hike. It's unclear when we will see a decline, but for sure, interest rates have been impacted. Last week, the Association of Ghana Industries expressed concern about the situation, lamenting the impact on the cost of loans. Listen to Chief Executive Kwawu.
We can understand the Bank of Ghana. The policy rate is being used as a tool to slow down the inflation. So sometimes some of these measures are taken. But the bottom line is that once such measures are taken, the implication is clear. The implication is that interest rate will go up. And it gets to a point where the banks get more interested in even investing in government bonds and treasury bills and all that. It means it's crowding out private sector access to financing. And even for the private sector, even when you have access, sometimes it could be dangerous if you are picking loans at a very high interest cost. It makes it very, very, highly commercially unviable for a lot of the businesses you do. So it's really a concern that we have such situation. The question is, do we have a choice under the circumstance? Well, we can interrogate that with Bank of Ghana, whether there are other models of, managing the situation. For now, this is the arrangement or the policy rate is being used as the tool. But I think that whatever it is, whether it's the best option or not, the implication is clear. And the implication is that it denies private sector access to good money to expand and all that. So it can only be temporary. If the situation, if you don't have a choice then to go by a policy arrangement of this nature, then it can only be temporary. Because if you make it too long, it will have a dire consequence.
That was JoyNews, the Chief Executive of the Association of Ghana Industries. Managing Director of GCB Bank PLC, kwawu, has been speaking about the concerns raised by the business community. He says commercial banks have no choice than to be circumspect in lending to the private sector to reduce high non-performing loans as a result of rising inflation. According to kwawu, interest rates are going up, and that requires managers to take prudent decision on who to lend to. He told some journalists the situation is challenging but believes it is for the short term.
When it goes up, you see what happens, interest rates go up. When interest rates go up, I mean the cost of borrowing increases. Okay, government paper are going up, interest rates are going up. Banks have to balance their portfolios. So the level of risk, like I said, then tightens. Okay, the kind of your risk appetite reduces because the chances of people working to pay back a loan at very high interest rate reduces. And as a bank, our business is about lending money, taking money from people who have surpluses and lending to those who are who need the money. And so inflation, like we are experiencing now, is not too good for lending. It presents a challenge, no doubt.
Are we seeing interest rates going up? Policy rate has gone up.
Yes, interest rates are going up. I mean, in all the banks, GCB's rates are going up. And it's a challenge we have to deal with because interest rates can go up so much. And we have to take decisions about who and how we lend. And that's what we are going through now. Okay? All right, thank you very much.
Well, more on this, I'm joined by Chief Executive of the Ghana Association of Bankers, John Ewa. Grateful you could join us this afternoon. So we can start by you helping us, our audience, understand the dilemma banks are in right now when it comes to credit following the policy rate hike, having to serve the interests of customers and also ensuring that you are not piling up non-performing loans.
Thank you very much and thanks for having me. Yes, it's a huge dilemma as banks. Contrary to public opinion, higher interest rates are not necessarily good for banking because of course, if the interest is so high, the interest burden on the borrower is so deep, and that can fuel the onslaught of non-performing assets. So we, as community of banks, are also concerned when you have a situation where rates are on weekly, on daily, or weekly and monthly basis inching up, not because banks are happy to just be increasing the rate, but because the fundamentals and the derivatives that drive the lending rates are all looking upwards. And that is basically the dilemma that banks presently find themselves in.
And so the GCB Bank MD, Kofi Adumako, talks about banks being circumspect about who to lend to. Typically, what would be the consideration for banks?
Yeah, banks are in the business of financial intermediation. So you look at the circumstance of the customer. Of course, the various banks have their own internal risk acceptance criteria. I'm not sure the credit covenants will change significantly. But of course, because of the lending rates where presently it is possible that the funding requirement of most corporates or most businesses will go down. You need to factor in the cost of the borrowing into your cash flow projection. And if the cash flow projection does not support it, the bank will have to take a decision on how much money to give you, or in some extreme cases, whether you will qualify in the first place at all. So banks during these kind of uncertain periods are extra cautious as to where and when lending is given. But I must say that there hasn't been any decision by the association or in interaction with the banks where banks are closing the taps of credit, not at all. But of course, they will be looking at the credits with both eyes open and all, ears on the ground.
But we've got the business community already raising concern about the high cost of credit and how that is impacting on their operations. You had the CEO of AGI a while ago. While we acknowledge that interest rates have to go up, I'm sure banks also need these businesses to survive as well. And so the AGI president talks about engaging the central bank to influence commercial banks to provide credit to industry at a relatively lower rate. Would that work?
We've heard these comments before, and our position has been one that interest rates, have never been a subject for regulation in terms of mandating, stealing for lending rates. Just like AGI will not be happy for their products, the pricing for their products to be determined by a certain external hand. The same way we are in the same market. Why would you want a bank to go through that regime? And in the first place, countries that went that route have all reversed because you cannot legislate it. It's not like the banks have woken up all of a sudden and have gone to increase their interest rates. T-bill in February or January of this year was around 12.5%. As we speak, it's at 21%. The Ghana reference rate, which is a combination of the policy rate, the interbank lending rate, and the treasury bill rate, was 13.9% in January of this year. It is presently at 20.8%. So it is not a matter of the banks, it is the fundamentals that are driving the rates to the levels that we see now. So we should rather tackle it from the root and not look at the symptoms and see who can we touch in order to have some comfort for a certain segment and then some discomfort for other players within the same economy. Just as AGI will not be happy for the prices or the prices of their products to be determined by a third party, I'm not sure they should be pushing for any agenda that sets the lending rates for banks.
So tackle this from the roots, you say. I also want to pick your thoughts on what the GCB Bank MD said. He thinks that the hikes in the interest rates is only in the short term and that the central bank is hopeful that it would return to a single-digit inflation next year. What's your forecast?
We are very much with the governor when the governor said that we believe the present situation is for the short term. We all know the global economy where we are playing, and we also believe that most of the inflation that have pushed the rates to where they are now are imported inflation, and that as circumstances around the world with the supply chain constraints, tapering off, we envisage a gradual decline in inflation, and which should positively impact the lending rate. So we have every cause to believe that it is temporary. It's a concern, even if it is for the short term, but we believe that by this time next year, we should not be trending around the rates that we have at the moment.
That sounds positive. Thanks very much for your time, John Ewah, who is Chief Executive of the Ghana Association of Bankers. Grateful you could join us this afternoon for this conversation. All right. Now, government statistician Professor Samuel Kobne has highlighted price variation of commodities at market centers across the country as a problem that needs fixing. According to him, imported rice in 5 outlets in Cape Coast, that's in the central region, for instance, is in excess of 100%, a situation he says is unacceptable. He was delivering his inaugural lecture at the University of Cape Coast.
The human factor in the variations in our prices during economic turmoils are pretty significant. 2018, nothing was happening. You see the stability in prices across the 54 outlets. During the COVID-19 pandemic, you see the variations, and during the Russia invasion of Ukraine, you see stark variations across the 54 markets, with some outlets selling a 5 kg of imported rice, specifically Gino rice, over 108 Ghana cedis. I took the pain to check just last week, and it's just 63 Ghana cedis somewhere in Accra. I did say in my last release that households have been deprived of information on prices. Indeed, if you take the data on Cape Coast outlets alone, 5 of them, Cape Coast outlets alone, you see a variations in excess of 100%.
Professor Enim also indicated the country does not seem to have a firm grip of the economy. He explains that capital flight has become more than inflows, and such variables are hurting the economy.
So the discussion on capital flight always requires a context. The reason why it's important is we have 2 types of it. One that is purely legal. Somebody is in the country, does business, and the person would want to invest their resources elsewhere. And the other is the illegal part, which is mainly as a result of illicit financial flows. So it's pretty difficult to measure capital flight. But the emphasis of today's lecture was tracking the extent of capital flight and over time making a case whether we can see a downward trend in capital flight. So today I demonstrated the extent to which it's a challenge. For instance, in 2010 it was about 20.8 of our GDP, and broadly the argument that I put forward is that it's very volatile, which means that there are instances where it's positive and quite a high positive, and instances where it is negative. So the volatility sort of limits our ability to plan with capital flight. It means we cannot even predict the tax returns that we get from the profits that expatriates makes on businesses in the country.
Let's bring in Chief Finance Officer at the Valley View University, Dr. Williams Pepra, to get some perspective on the issues raised by the government statistician. Good afternoon to you, Dr. Pepra. Is there any way we can check price variation of commodities on the market? I've heard some suggest we introduce a price control regime, but the finance minister has said that that is not an option.
Good afternoon, Daryl, for calling me. So on the issue that has been raised by the government statistician on the issue of price disparities within the country, whereas the finance minister is not ready for us to move into price control, which is a mechanism normally applied when the country is experiencing high inflation. An important element that we can use to control this effect is information, making sure that there is information asymmetry or balance of information spread through all the country on commodities. So, for instance, can we have all the radio stations, some of them doing their business profiles, be putting the prices of commodities across markets for citizens to know the price of, let's say, rice, a bag of rice at Medina, a bag of rice at Kumasi Central Market, a bag of rice maybe in Tamale, and the rest. So once citizens are aware of this information, it will slow down the intermediaries who are highly profiting from this issue, whereby we have some form of, we all have a clean knowledge of how prices should be. But to address this issue of high prices is what we have to go into and look at the fundamentals, which we have always been talking about it. So, as mentioned, our inflation situation is an important inflation factor. So the first one is the price that we get our goods from outside the country. And the second factor is the exchange rate of which these foreign goods are exchanged into Ghana cedis. So that is where we should address it from, so that we'll be able to have prices variation. So the example the statistician gave in Cape Coast, yes, it can happen that at 3 outlets, prices will be different because they will be coming from different suppliers, from different countries, and maybe these sellers bought their items at different prices. So they are trying to adjust to make sure that they don't lose money. So that is why this is happening. But as I've mentioned, if government is able to use the media, the communication team, to try to come out with prices of commodities across the country, it will help. Not only relying on the Isoko and the rest, maybe Joy FM will also sometimes come out with, or multimedia, to come out with commodity prices for goods outside the country. Now, probably your attention should be also on markets within the country, so that prices will always be the same. Citizens need to know how much a bag of rice is sold in Medina, and they can make a decision whether they will have to move from maybe Tema to come and buy it from Medina because the price is cheaper. Well, it will force other markets to make sure that the prices are the same.
We've started something like that with our shopping list, Joy Business shopping list. But I want to move on and talk about the government statistician also raising issues with capital flight. Huge money outflow, which he says is hurting the economy. How much of a problem is this?
Thank you very much. So I think the government statistician was a little bit careful. Instead of giving us the monetary value, he gave us the percentage. 20%. So yeah. I'll just go by giving the monetary value. So in 2021, it was $11.6 billion in terms of capital flight. That is how much the amount of money that left the country. So it left because, one, it may be investors are repatriating their dividends out of the country. And normally when investors are repatriating their dividend out of the country, you give a signal that they are not prepared to reinvest within the country, so they are moving their profit out. And which is a major issue that government must have to address. Like when you go to South Africa, they have a plan and a strategy on how multinationals will have to transfer dividend out of the country. Then you are able to control your country's economy. Also, when you see that there is manipulation of currencies, you always experience capital flight. I'm just saying it as a signal. So remember, about 2-3 years ago, it was said that the city we have arrested the dollar or the movement of currency. And you ask yourself, what has happened now that there's a sharp increase or devaluing of our cedi? If you are an investor and a foreign investor, you would think that probably there is manipulation of the currency in the country. So the economy, in the terms of microeconomic sense, is not very stable. So you want to move your currency out of the country. Also, another factor is when you see that there is political instability. When we talk of political instability, it's not just war, but also what happened during the parliament section in the approving of the budget points to a political instability. Indeed, we are experiencing political instability because government cannot use its numbers in the parliament house to push its way through. So you will see that government will have to struggle. And if you are an investor and you see that the government in power is struggling to get its policy accepted by members of the parliament house, then you will see that there is that kind of political instability. Okay. So these are the factors, the main factors that are seen in the books, and that is government, a country like Ghana, we are seeing it and it's causing it. And the major factor, as I've mentioned, is also when you see that corruption is also a factor in the country. You will see a high rate of capital flight. So we saw Ghana as a country, our rating dropped when the corruption index was released. So these are the signals. So if government wants to work at these things, we need to address these factors. And then I'm sure that it will slow down the capital flight or money being sent out of the country.
Okay, and earlier we had a discussion on high interest rates and the impact on the business community, but you say it is a good opportunity to save and invest. We have just about a minute. Tell us about that.
So the strategy, what happens to inflation is that it means more money chasing less goods. So if a country wants to stop it, you have to make sure that you produce more goods. But if you see Ghana, we are not a producing country. So we may have to find a way to move the money in the hands of citizens into another venture to make sure that we control the economy. The next option is to encourage savings. So now we know that treasury bill rate is going up. So this is the time for you to go into savings. You will see that all the banks, well, as we are discussing, are now no more interested in giving money to companies or businesses, but they are going to channel their money into savings. So if even a bank has gone into investing in government bonds or government instrument, how much more citizens? So we need to reduce our expenditure and then encourage more savings and to reverse the impact or the inflation that we are experiencing in the country.
All right, Dr. Williams-Peprah, good to speak with you this afternoon, Chief Finance Officer at the Valley View University. I appreciate your insight. Well, speak about investments. Some good news for you. On the money market, results from the last T-bills auctioning, government met its target and recorded an oversubscription, yes, by 165.70 million Ghana cedis for the first time since March 2022. Joining us is Patrick Edem Agama, who is head of trading at Republic Securities, with some perspective. Hey, share with us, Patrick, what accounted for this oversubscription and how is trading generally on the treasury market?
Well, Daryl, good afternoon. For this SS subscription, it was largely on the back of the subscription of the 91-day treasury bill. Investors' appetite for that 91-day treasury bill is growing very, very fast. And this is because we've seen it close at 22.57 interest rate, and BBs as high as 23.5% were accepted for this particular auction. For the 182-day treasury bill, it stood at 172.96 million for the bids tendered, but only 171.01 million were accepted, which also closed at 24.41%.
All right, and I guess this is the only time people are really excited that interest rates are going up. How about the secondary market? How is that also faring? What should we expect this week?
Well, for the secondary markets, last week we saw a decline. If you look at the week-on-week trade volumes, we saw a decline by 25%. For this week, we expect muted activities until the release of the new inflation figures on Wednesday. So we expect investors to study the market a bit before taking decisions on that market.
And what should we expect on the stock market? My eyes are on Access Bank shares. Tell us what is happening there, what you're seeing.
Well, there's still significant demand for stocks like Access Bank, SIC, and MTN on the market, as we expect the market to trade a bit higher than the volumes we saw last week. We are still in the dividend season, so investors are taking advantage of that to take their new positions before the dividend qualifying date expires. So we still expect some activity on that market as well.
And before you go, I just want to take you back to the news on the treasury market. For how long do we expect to witness this, sudden situation where government has met its target? For how long do you think this is going to continue? Is it for the short term, or we should expect this to go on for a while? Your forecast?
Well, in my opinion, I expect this to go on for a while, because if you look at the bids accepted for the 91-day, as high as 23.5 were accepted. So it should tell you that the next auction, we should expect bids to be going to that level. For the 182-day, as high as 25% of bids were accepted. So it should also give us an indication of where investors' appetite are for the coming days.
I appreciate your update, Patrick Edem Agama there. He is head of trading at Republic Securities. Have a good rest of the day, Patrick. And more news on our website, myjoyonline.com/business. We have that story there about government finally achieving target for T-bills auctioning, registering 1.395 billion cedis sale. Also, Construct Edge certified properties, built industry players edged. More on those stories and others on our website, myjoyonline.com/business. And that's the marketplace. Goodbye.